Next guest, he's out with his U.S. outlook for 2025, highlighting new policies, similar path. David Mericle is Goldman Sachs chief U.S. economist. Nice to have you here on set. David, in your recent report, you discussed the fact that, coming up, obviously, with the new administration, you're expecting higher tariffs, lower net immigration, and a full extension of the 2017 tax cuts. But then you go on to say, while significant, you don't expect them to substantially affect the trajectory of the economy. My question is, why not?
Sure. I think tariffs will probably have the largest impact on inflation. But if we get sort of an intermediate scenario with some tariffs on China, perhaps some tariffs on autos, but not the large universal tariff, we estimate that would be worth about 30 to 40 basis points on inflation. Now, in the absence of tariffs, we would expect the underlying inflation trend to be falling from the high twos to the low twos, basically for the same reasons that it fell this year that Chair Powell talked about on Wednesday. That what's left of the overshoot of 2% largely looks like catch-up inflation, and once you've caught up in level terms, you don't expect any further catch-up in growth rate terms. So the implication of the tariffs would be that maybe we fall to the mid-twos rather than the low twos, some effect there, but doesn't dramatically change the path. On the GDP side, the different policy changes would have offsetting effects. Fewer people, fewer immigrants means fewer workers. That's modestly negative for GDP. Tariffs function like a tax. They'll probably also invite foreign retaliation. That would also, we think, have a negative effect on GDP. But we do expect some tax cuts, the full extension of the 2017 tax cuts, including reinstatement of some business tax incentives and some additional tax cuts. Those will probably come a little later, so I'm more comfortable saying these policies are offsetting over 2 to 3 years. Maybe at the beginning we'll get the tariffs. This will have a slightly more negative effect, but not a huge one.
Obviously, all of this, we just don't know. I mean, how broad, how deep, for example, when it comes to both tariffs and deportations, and then even the tax cuts, we'll have to wait and see. We're just seeing what's going on right now in Congress. All that said, you got to make a prediction. So, but, if things remain the same, do you expect that we will get to 2%?
Not this year, but probably next year.
You mean not in 2025?
Not in 2025, right. Exactly. That in the absence of tariffs, we think we'd get pretty close to 1.22. With tariffs, we think we'll get to 2.425. Now, it shouldn't be that complicated to get a sense of roughly what are the tariffs worth. Net of the tariffs, which are after all a one-time price level effect, where are we running? So we might have a little bit more confidence by the end of next year than the inflation numbers suggest.
Finally, one of the surprises among some this week was the Fed forecast for unemployment. Some feel that the level of job openings suggests more vulnerability to the labor market than maybe the committees take it into account. Where do you think we top out on UE?
Yeah, so we also have the unemployment rate staying roughly stable. We have it at 4.2, they have it at 4.3, but we are within half a basis point of 4.3, so that's a small difference. I would also be a little bit more focused on risks on that side of the mandate. I'm not particularly worried about inflation, and I'm not that worried about the labor market because I think the main reason that the unemployment rate rose is simply that it was hard to digest millions of additional immigrants, create jobs for everyone in a short period of time. Labor demand is not weak. The layoff rate is extremely low. I think this problem will solve itself now that immigration is down, but I don't know that for sure just yet, and I thought Chair Powell was right to emphasize that we should be attentive to that risk of the labor market cooling too much.